Investors cheering Europe's bond buying plan today and the trio of positive U.S. economic data that we just told you about. But is this market rally here to stay? Especially in a month that's historically been one of the worst months of the year.
Yeah, we've got our panel of experts to weigh in as we look ahead to the jobs report tomorrow, the president's acceptance speech at the convention tonight, Meg McClellan of J.P. Morgan Private Bank, Randy Bateman of Huntington Funds, Keith Springer of Springer Financial Advisors is also with us, and Rick Santelli is staying late for us tonight. And Rick, first this is a government-induced rally. What do you make of this, of the market response today? Very dramatic and strong.
It is dramatic and strong, and I agree it's government-induced, but it still doesn't change the fact that everybody in that S&P pit, if they choose to take out the money of their long position today, they're going to get a check. So it's real in that regard. I think a better question is, 1 or 2 years down the road, is Spain's unemployment and housing all going to catch up with it? How long is this funding relief valve going to last? And I heard headlines out of Spain. They said, wow, rates have dropped. Do we even need a bailout? Do they not understand what's going on?
Right.
Yeah, it's pretty incredible. Randy, how about you? You just heard Rick's skepticism. Is Europe's crisis really contained? So what do you do? Do you buy into this rally at a time when you're seeing some red flags?
You know, we've been listening to this for so long that this is at least a positive move forward. They are going to do a sterilized buyback, and that's going to be important. What we really think is really going to be important, though, is can this get the individual investor off the sidelines? You know, they've been dealing with low money rates, low treasury bill rates. The stock market has done pretty well this year. We need to have some stimulus to get them off the sidelines and into the markets. This could very well be the thing.
Meg, you're the head of fixed income there at the J.P. Morgan Private Bank. What do you make of the yields coming down in Europe? They're going up here in the United States. I mean, what happens if the jobs number is a solid number tomorrow? Do we continue to see rates rise here in the U.S.?
Yeah, so a lot of the recent move in interest rates has not necessarily been on the back of the ECB, but more on Fed expectations. So if we get a strong jobs report tomorrow, you're going to price out some of that QE expectation that's been priced in the markets, and you're going to probably look for a softer message from the Fed, potentially extending communications around zero interest rate policy into 2015 versus the current 2014. But certainly a strong payroll number, I think, gets us more focused on the Fed and less focused on the ECB actions today.
Hey, Meg, I'm looking at Spain debt yielding 6%. Yeah. Now that we know that the ECB says they're going to be in there, we presume, do you buy it? I mean, boy, if you're looking for yield, holy smokes.
So I think that until we actually see Spain and some of these other countries commit to being engaged in this program, you're going to see a little bit of volatility around the debt market. So certainly the yields on the short end have come down 150, 200, 300 basis points in Spain, Italy, and Portugal. And you would expect some of that roll down from the 10-year sector and the 5-year sector is sort of thinking and anticipating those bonds will eventually roll into that 3-year maturity that the ECB is promising to buy. But, you know, in terms of thinking about ways to get 5 and 6% yields, there's much better ways, I personally think, to do it.
Like
strong corporate balance sheets, using a little bit of that leverage, the free money the Fed's giving you right now to hit those same types of yield targets.
Okay, Keith Springer, as Randy said, he's wondering when the little guy is going to want to get back into this market. What about you? I mean, there's tremendous skepticism we've discussed here at length about this market rally. Are you skeptical, or are you in with both fists here?
Well, I wouldn't jump in with both feet right here, but that's the point. This market has everything you need. It has liquidity, and it has negative investor sentiment, and that's what you want. You don't want believers. That's what pushes the market higher. This market is addicted to stimulus. It's not economics driving this economy. Everybody wants more stimulus. That's what it keeps getting promised. So that's what they're looking for. We've got nobody believing it on the retail end. The average investor doesn't believe it. Bond flows keep going up, but stock flows keep going down. We've got incredible negative sentiment. We've got a lot of liquidity.
But
so for the time being,
right? I mean, I hear all that skepticism, and yet we're at multi-year highs. I mean, you've missed a lot if you haven't participated.
Exactly right. You've got to be somewhere. You don't want to be in cash. You don't want to be in the bank earning 0.2%. That's going to be the top of the market. You hit it right on the button. When complacency comes into this market, probably in the first quarter of next year, you're going to see a turn. I think a bear market does start next year. I don't think we see QE3. I don't think Bernanke uses it to push the market that is already at a new high higher. I think he uses it as a protection against calamity. I think he's going to be there if it goes below 11,000 or 10,000, but certainly not to make it higher than where it is today.
Right. Rick Santelli, what are your expectations for tomorrow with the jobs number, and how much higher do you think your long-term yields could go here?
Well, I think my expectations are for about 160,000 number tomorrow, and I think the floor is maybe a little lower than that, more with the consensus around 140. But even if it's 200,000, I think in the context of Steve Leisman saying that quantitative easing's coming no matter what the data says, I think it's very hard to handicap exactly what's going on with equities. But I will tell you this, I think that interest rates are going to be creeping higher back towards that 180 level in the 10s, no matter how the data turns out.
Yeah, Meg, I don't know if you heard Leisman earlier, but he thinks QE3 is coming regardless because Bernanke sees the unemployment situation as way too grave. So what do you think in terms of tomorrow's number? What does that mean ultimately for yields?
So we had a pretty reasonable number sort of in mind because of the ADP jobless reports and some of the initial jobless claims that were coming out. It's certainly not strong in broad historic context, but strong for this type of recovery. And, you know, to us, that means that the Fed needs to sit back and digest some of the data coming in, because if it comes in a little bit stronger, you see much less pressure for QE. And, you know, I also tend to think that if you look at the last time there was a QE post-Jackson Hole, it wasn't the next meeting. It was much, much later. So this idea that, you know, after Jackson Hole, the Fed necessarily does something is a little bit of revisionist history. So I think the Fed's going to be in wait-and-see mode if we get a strong data number. And again, thinking more about the communication of that short-term interest rate than necessarily QE for this next meeting.
All right. Thank you, folks,
Thank
for
you.
a conversation. Take care. See you later. Rick, thanks for staying late for us, buddy. We'll see you later.